Katie. Okay, we're gonna, wow, that's loud. We're gonna get started now. Thank you for your patience. I just wanna welcome everybody here to this session. It's an honor to be here today, and thank you all for coming. I know it's sort of that time between the end of the day and cocktail and reception hour, so really appreciate everyone's attendance. I'm Molly Helmuth of Winrock International, and I'm co-moderating this panel with David Albertini of the R20. The R20 Regions of Climate Action was founded in 2011 by Arnold Schwarzenegger, and they incubated the Subnational Climate Finance initiative, which will be one of the focuses of the second panel today. Winrock International, where I'm sitting, was founded about 70 years ago from the philanthropy of Winthrop Rockefeller. And we have a long history of working on climate change adaptation and mitigation through our global programs, which exist in over 40 countries, but also through our carbon registries. We also host the American Carbon Registry and ArtTrees. I personally have been working on climate change and development for 25 years, and I have to say it's really nice. I took a hiatus from COP for about 10 years, and it's really nice to see just how much it's expanded. Outside of the negotiation room, I've never seen so many pavilions and people and momentum and excitement. Also nice to see the engagement or the progress that's being made in terms of engaging private sector actors and private sector finance. But at the same time, as we highlight in my forthcoming U.S. National Climate Assessment International chapter, the reality is that finance needs to be significantly scaled if we're going to be able to meet the challenge with the ambition that is required at this stage. The objective of this session is to highlight the challenges and the opportunities and innovations in the mobilization of private sector finance to support both mitigation and adaptation investments, including in REDD+, forestry, and climate-smart infrastructure. And we will start with some introductory remarks from Daniel Candy from the US State Department before going into our two panel sessions. As I mentioned before, each speaker is going to identify the types of problems that they're looking to address and how they're working with the private sector to increase finance and actionable outcomes. So without further ado, I will introduce Daniel Candy to kick things off. Daniel Candy is the Director of Sustainable Landscapes at the U.S. Department of State's Bureau of Oceans and International Environmental and Scientific Affairs. He leads the State Department's work on REDD+, forest, and agriculture, which includes carbon markets and climate finance, and he also conducts bilateral engagements. Thank you. Daniel?
Great. Thank you for the introduction. I wrote some remarks down, but I'm really distracted by only now realizing that Winrock is Winthrop and Rockefeller put together. I had no idea. This is the most significant thing I've learned in the last 10 days. So I wanted to focus my remarks on the role of government in mobilizing private sector finance. I sit in this weird vantage point when I come to a COP. I have one foot in the negotiations. I do the Article 6 negotiations. You all look very happy with smiles on your faces, and I put that down to the fact that you don't have to sit in the Article 6 negotiations. But it is a privilege to negotiate on behalf of the US and observe how those negotiations unfold and have an understanding of how they impact, outside of the process, what happens on the ground. In my other life, at the State Department, I manage a portfolio of around, I'm looking at my colleague Melissa, $50, $60, $70 million of climate finance programs, official development assistance programs, et cetera. And so understanding what the greatest actions that we can have to affect changes in enabling environments, shape best practice in technical implementation of NDCs and adaptation actions, and trying to leverage that tranche of money most effectively, recognizing that at the end of the day, governments like the US, as rich as they are, do not have sufficient capital to achieve the energy transition, the land use transition, the adaptation transition that we need in order to meet our goals and make the world compatible with a 1.5 degree line future and resilient in the face of the climate change that we're already facing. I'll speak to two of the projects as examples of this in my opening remarks quickly. Coincidentally, they are projects that we are funding through Winrock. And so just to give you a sense of how we as the US approach this issue of where the government comes in and what we think it'll affect on the ground in terms of mobilizing private sector finance for mitigation and adaptation. One is the PIER program, Private Investment for Enhanced Resilience. Under the PIER program, we recognized that there was a real surfeit of investment from the private sector in adaptation actions. We'd more or less figured out a lot of modalities for investment in infrastructure, transport, energy, to a degree land use. But adaptation was still, if you looked at UNDP reports or others, consistently lagging behind in the quantum of finance towards adaptation. So we set up this program to work in 6 countries and develop a number of pilot programs that would develop tools, provide advisory service, guidance, and develop essentially a set of best practice and understanding of the challenges and barriers to private sector engagement in adaptation, investment, and actions. I'll allow the panelists to speak in more detail to some of the outcomes and successes there, but trying to play this role with often, not huge amounts of money, maybe $5 or $10 or $15 million, but to really try to pilot new approaches and try to have a role in supporting innovation. The second example I'll speak to is what we call 1SL, or offsetting national emissions through sustainable landscapes. Going back to the negotiation space and international processes, here we're speaking in the language of nationally determined contributions, national accounting, but in the land use world, in the forest world, we still have REDD+ projects operating at project scale. And there's this really beautiful and collaborative ecosystem in a lot of countries between the governments, project developers, and other actors to set up REDD+ projects that are achieving emission reductions on the ground. But as we recognize that we're operating in this world of national level accounting and scaled up action and moving towards jurisdictional approaches to REDD+, how do we support countries who are have a number of REDD+ projects on the ground and figuring out how to nest those projects into a jurisdictional level program and an accounting baseline. So we partnered with 1SL to work in 3 countries? 3 countries. It was originally 4. I won't tell you which the 4th that fell off, but 3 countries. Kenya, Zambia, and Colombia, which have radically different contexts in terms of the types of projects on the ground, their approach to jurisdictional REDD+, their capacity and bandwidth to undertake these complex technical and policy questions around nesting of REDD+ projects into a jurisdictional framework, and provide that really engaged, focused support to those governments to navigate these really complex questions that have significant financial and mitigation outcomes. In this way, we really hope to support ongoing private sector investment, whether that's in a jurisdictional program or a project scale REDD+ project, and enable those governments and jurisdictional actors to access international carbon markets, whether it's under Article 6, CORSIA, the voluntary market. So in sum, I'd just say that we as governments need to keep in mind the overall international processes and context in which we find ourselves and recognize that governments must play a role in setting up frameworks for the implementation of adaptation and mitigation actions, but really support innovation and other kind of new innovative ideas that will help enable the private sector to engage those processes and to deliver the underlying actions that countries really need to take. I'll pause there. I was only supposed to deliver opening remarks, but it's really nice as a person who really craves attention. I think I'll sit up here for the panel, and if there are any interesting questions, maybe you guys will let me answer some. But I'll stop there, and we can turn it over to the panelists and begin the session.
Great, thank you, Daniel. I was going to hand it off to our panelists, but it looks like we are perhaps down a panelist, which is okay. We can pivot, and Daniel, maybe you can fill in for Antwi. But the first panel, we're going to hear some examples, and Daniel pretty much just introduced them. The PEER project and the 1SL project are Department of State funded projects where we're looking to engage the private sector actively, and private sector finance in particular. And we're also going to hear about a project on reducing emissions from peatlands, or a program on reducing emissions from peatlands, funded by Good Energies, the Packard Foundation, Consumer Goods Forum, and the Climate and Land Use Association. And we have two panelists. Can you go to the next slide? Do I have the... I did press the button. Okay. Thanks. So we have two panelists. The first panelist that was going to speak was Dr. Antwi Boasiako Amoa, the Director of Climate Vulnerability and Adaptation of the Ghana EPA. He was going to speak to the PEER project, so maybe we can get some additional remarks from Daniel on that program. And then the second panelist that we have is Arif Budiman, who is at Winrock International, and he's an Afalu and peatland restoration expert. And then finally, we're going to hear from Katie Gosley, who is the Director of Ecosystem Services at Winrock International and the Director of the 1SL project. So our speakers will give a brief overview of the problem that they're facing and how they're working to engage private sector and private sector finance. So, Antwi, or do you want to speak to, sorry, not Antwi.
I'll
Daniel?
do my best.
Okay.
The PEER project, as I was mentioning my opening remarks, there was a real gap and lack of knowledge and expertise in the private sector space in investing in adaptation actions. And I would say from my reflection, even though this program was initiated in 2017 and has undertaken a set of interventions until August of this year, there's still, I think, really additional work and development that needs to go in that space. But the PEER project really was originated as a program to try to acknowledge, address, and understand the barriers faced by the private sector in investing in adaptation globally, recognizing that there are incredibly different circumstances in each country. So we're trying to have a good broad geographic focus across those various countries. We ended up working in 6 countries: Ghana, Jamaica, Peru, Indonesia, and Grenada. And trying to work across levels, so with governments, the private sector, development banks, and others, and bringing in Winrock, who have deep expertise in these areas, to provide technical assistance, advisory support, and work in conjunction with those actors who understand the conditions on the ground to identify and address these barriers. So some of the interventions on the ground focused on how to support governments and financial actors, business associations and others in coming together to address some of the challenges in terms of enabling environments, the policy conditions, et cetera, that exist on the ground that are standing in the way of further investment in adaptation. There was also work on analyzing climate risk related to agriculture and how that impacted private sector investment in resilience. And over the course of the 5 years that we were implementing the program, we showed that private sector actors and private sector finance really is interested in engaging this space and figuring out how they can support and invest in adaptation and resilience. And we're able to really operationalize some of the concepts of climate adaptation into standard practices such that the private sector can now actively seek investment opportunities around the world. So we've concluded the program in August of this year, but we've built up this body of knowledge both for the world to use, but also for these 6 countries, and really look forward to seeing how that plays out now that we have some more expertise and knowledge in this space. Is there anything do you want to add, Katie?
First, thanks so much, Daniel, for stepping in. I would just like to say that our colleague Antwi, who was meant to be here, I think is a prime example of how it's, when someone wears a lot of hats, Antwi is also a negotiator, it can be difficult to take off one hat and put on another. So absolutely understandable that he's not able to make it, but just a quick word about the activity that we conducted in Ghana with Antwi's under Antwi's partnership and the Ghana EPA's partnership. They had a partnership agreement, not a partnership agreement, excuse me, a strategy for engaging the private sector in financing resilience. And we worked with them to develop a capacity building strategy to implement their actual engagements of the private sector, ensuring that within the Ghana EPA there was the actual knowledge and awareness of private sector needs, private sector interests, and how that does and does not align with resilience. And just, I think that's one great example of really the breadth of the different needs under resilience efforts that exist. Just very quickly, some of our other activities included at the policy level, interventions at the policy level, actual finance from private sector to develop infrastructure, and cost-benefit analyses of the implications of resilience on the financial activities, particularly in the coffee and cocoa sector. And so I think those 4 areas, capacity building, financial analyses, actual financing of efforts, and policy engagement do not cover the entire spectrum of needs to engage the private sector in resilience, but definitely represent the breadth of activities that are needed, as well as learnings that are needed to be able to fully operate at the level needed to finance resilience efforts.
Great, and I think that's a really nice example of what Daniel was just talking about in terms of the public sector really creating a framework, and in this case including capacity building and support to engage the private sector. Really important. We see that there may be a lot of, a big push for private sector funding and finance, but oftentimes you have to even create the demand. So I'm going to ask Arif Budiman to start his presentation now. Thank you, Katie and Daniel.
Thank you, Molly. Yeah, it's a great pleasure to be here. So basically, I would like to present our work in Siak, Riau province of Indonesia in the last 5 years. So Siak is a very unique landscape. We has 800,000 hectares of land, and more than 50% of their land is the peatland, and 70% of their peatland is degraded. So peatland is the key for Indonesia to combating climate change, to reduce emission as our part of our NDC. In our NDC, the highest target of Indonesia is 70%, at least 3 programs related with the peatland. So why this is important? Peat is the organic material that has been formed for more than 1,000 years, and then it not completely decomposed. But one is degraded, drained to be oil palm plantation mostly, or acacia plantation for pulp and paper industry. They start to decompose this and then emit huge emissions. Yeah? So you can imagine in 1 hectare of the peatland in deep 1 meter, it contains 600 until 1 million ton of the carbon. And if it's drained or degraded, it will be released 90 tons CO2 emission per year until it's disappeared or until it's restored. So this is important for Indonesia. So we work with the stakeholder in SIAC when the SIAC government have a commitment. It's pledged in 2016 after huge disasters of fire in 2015 that give a lot of the loss of economy. So we started with working with the policy and also with the community and how to mainstreaming the development, sustainable development into development plan, which is also part of the implement of NDC in also to put or mainstreaming the commitment. There's some objective that match with our NDC from the SIAC government commitment that we call the Green SIAC or SIAC Hijau. Namely, first is they commit to avoid deforestation and peatland degradation. And second, they want also to improve the social economy of the people, community who live within and surrounding areas. And third, they also encourage and support the company operational to be more sustainable. That's the principle we think that's matched with our NDC. And as a part of the NDC implementation, mitigation action, part of the NDC. So after we work with the policy as the basis of umbrella of the activities of implementation of their commitment, the next challenge is how to maximize the financing from the private sector, because this is huge potential, how to fund this financing to the project, to the restoration program, to reduce emission. There are 3 approaches that we conducted with these challenges. First is we promote the net zero emission for the big company who's operational in SIAC, and also we give technical assistance to them to identify the source of the emission from their land value change. Then the second is try to find the market share, investor or buyer for the peat-friendly commodity that we call polyculture. And third is to encourage them to work on involved in the project that's conducted by the community or local government. That's maybe the initial steps, still a lot of big challenge, but we believe that this is first steps, like in our slogan, for together for implementation. That's maybe I will stop there. Thank you.
Great, thank you for that, Arif. It's really, really nice to see some progress being made, especially when we think about mitigation and adaptation and the types of transformational shifts that are going to be required for us to meet this problem at scale. I'm going to move into the question and answer piece of this. And I'm just kind of looking at you, Daniel, and thinking, can you stand in for Antwi on this one or not? But I think you can. So the question that I was going to ask Antwi was whether or not, how you think the lessons learned from engaging private sector in mitigation finance can be or cannot be applied to adaptation needs? What can be learned from mitigation finance that could be applied to adaptation?
I have my own perspective on this that I'm happy to share briefly. I think fundamentally there's a real set of challenges in applying modalities of private sector finance in the adaptation space. I work a lot in the world of REDD+ and carbon markets, and I think that trying to unitize and sell some kind of adaptation credit is really a challenging idea. And so when you lose that kind of approach, you're cut off from an entire potential stream of finance for adaptation actions. At the same time, I think in a lot of cases we've been thinking about adaptation as adaptation finance as additional finance. I think as the US government, when we think a lot about adaptation finance, it's what is the additional quantum of finance in a project you were going to do such that that project is climate adapted and resilient. And so when you're hardening infrastructure, developing new green infrastructure projects, etc., viewing them not as a kind of independent investment, but what quantum of investment we're going to put anyway, and how much more do you need to spend to make it climate adapted. And in many cases, at least in the stage that we're in right now, governments likely should have a role in either putting up a portion of that additional finance or figuring out a way to de-risk or otherwise make that investment attractive, because it really is in our interest to make sure that adaptation spending happens. That's my view.
Yeah, and I really put you on the spot there without any advance warning, so I appreciate that answer. I think you're right, though, they are sufficiently different, but I think the blended finance that you were talking about at the end there is really an area where we can kind of learn from what's happening in the mitigation space. And it's nice to see that proof of concept, even if the structuring is a little bit different. It's nice to see that has really exploded, at least in the clean energy space. So I think there's a real opportunity and appetite for bringing that into adaptation, and it's happening. And we're going to hear about that shortly. Arif, you spoke about working with local communities, and I'm curious about how do you align the local objectives with private sector goals and objectives?
Yeah, thanks. A lot of the big company, global companies, has a concession in SIAC, so that's also the problem. Since sometimes the office in the field is different, has a different policy, or the global company different policy with the local policy, or then first, of course, in our experience, we need to encourage the big company to have a net zero commitment, or at least they have to reduce emission from them, not only from the supply chain, but also from value chain. So that also, they also can start with from the like CSR fund to more match with the local policy, because the local policy, of course, in our expression, is part of the NDC. That's also the second. And third, they also try also to give benefit to the surrounding the area to help the community, while also to guide the community to be more sustainable, practical. That's maybe the short answer.
Okay, thank you. Still some challenges there, I know, to make those two different perspectives align. Last question for you, Katie, has to do with, you spoke of some of the, I don't want to say barriers, but some of the enabling conditions that need to be put in place for private sector finance to come in. Can you identify some of the successful efforts in terms of jurisdictional REDD in terms of engaging the private sector?
Yeah, absolutely. I think at the project level, there have been a number of successful efforts of private sector engagement and moving towards the development of emission reductions and marketable credits. And I think that provides a really great example of many things, actually, but among them, the interests that exist for RED and private sector engagement in RED, and again, generating and purchasing credits, as well as the potential for private sector involvement in an ex-ante approach. So providing support for the development of programs, not just the purchase of credits. I think we're definitely seeing a very strong interest from the private sector in jurisdictional RED in a few examples already, but one of the most notable is through the LEAF Coalition and commitments that companies have made under the LEAF Coalition to commit to the purchase of credits when they're available. And I think that is, that's pretty new. It's been needed. It's very nice to see that happening. And it's also been difficult for jurisdictions, countries, and subnational areas to provide the supply to meet that demand. And I think there really is the need for that ex-ante support. And I think at the project level, there is an example of that. It would have to look quite a bit different at the jurisdictional level than it does at the project level. But I think there is an example that with lessons that can be learned and additional challenges, but that's a story for another time.
Well, it's nice that the demand is already there, and I think it's sort of it's beyond there's a famous movie in America where he says, "If you build it, they will come." It's a little bit like that, but it sounds like they're already waiting at the gates. So I guess if there's a possibility for facilitating the building a little bit quicker, then that would also be welcome and might help to achieve scale a little bit quicker. I'm just doing a little time check here. I think I'm going to ask for just one question across all of you, and maybe a little bit of a lightning response before we get to the next set of speakers, and I hand off to David Albertani. In all three cases that we heard, you gave kind of an overview, but in Ghana, there are still some barriers to private sector engagement. Are you optimistic, or why are you optimistic that the private sector finance will come in to support these initiatives?
So yes, this is challenging. Yeah, in our experience, it's very difficult since sometimes the project is not their business. For instance, in SIAC, we have 4,000 hectares of the degraded peatland that actually can be the first massive project in the restoration of the peatland restoration, and can avoid huge of the emission. But this is difficult. Sometimes the company doesn't want to because this is not part of their business. But yeah, they maybe want to try, but just small amount of the money or of the fund. Yeah, then yeah, that's maybe we need also to convince them that if their work is not only within their concession but also that surrounding the area. That's maybe the most challenge. But we are optimists since some of the company now more interest to join, to involve, and mostly to talk and to discuss what the best solution for the all. That's maybe.
Great, thank you. Katie?
Thanks. I think I'm gonna hack your question just a little bit because I think in both the case of actually resilience and and jurisdictional RED, I think it goes a little bit beyond being optimistic whether the private sector will engage, because they already have engaged. I think so I'm going to sort of shift the question a little bit to whether I'm optimistic that we can figure out ways to maintain that engagement and increase that engagement, and also, particularly in the case of jurisdictional red, meet the demand. And I guess the really simple answer to that question is yes, I'm optimistic, and also there's a lot of work to be done to get us from here to there, in terms of the accounting that needs to be done at the country level in the case of jurisdictional red, the demonstration of return on investment in both the case of jurisdictional red and resilience, and those are two examples, but various other efforts that need to be undertaken to really engender the confidence of both the private sector and companies that the private sector will show up. But even with that, I'm still very optimistic, again, that we can continue and increase the engagement of the private sector that already exists.
I'll just answer simply, very optimistic. I think there's obviously the interest and enthusiasm from the private sector in mobilizing investment for mitigation and adaptation. The trick will be developing the knowledge, the tools, the experience, especially in emerging markets, such that all manner of investors can invest at the scale that's needed. And I think a particular problem, especially in emerging markets, is unlocking that institutional capital. But I think that judging by the people here today and what I've seen around the Blue Zone over the last several days, there are a lot of really smart, dedicated people working on the problem, and I'm confident that we'll, in the next number of years, really see some interesting things start to emerge that really unlock a huge scale of capital, both for the achievement of NDCs and adaptation as well.
Yeah, I acknowledge it's a little bit of a softball of a question, but it's a great segue into our next panel, which will be focusing on private sector finance. And so I'd like to invite folks to thank our panelists. Thank you for your insights, and Daniel for standing in. Appreciate that. And so next panel, I'd like to invite David up to moderate. And the panelists.
Thank you, Mali. Oh, that's loud. Thank you. Hmm? Sorry? Thanks, everyone. I see the mic is very loud. Okay, so thanks, Mali, and so it is also my great honor to be here today with a great panel. Many people speak about blended finance. There is definitely, we see today at COP, more and more people, we are looking how we can, unlock private capital. And I'm glad today because actually I'm today with 4 practitioners of blended finance, people who actually work and walk the talk. So it's a great honor to be with all of you. So today I'm with Soji Omishore, the Deputy Director of the Private Sector Facility of the Green Climate Fund. I'm with David Kogut, partners at Pegasus Capital, working on the Subnational Climate Fund and the Global Fund for Coral Reef. I'm also with Vito Derbella, the Director of Sovereign Debt at CDPQ, and with Maggie Kim, the CEO of Gold Standard. So thanks all of you. And maybe I will just start with, kind of the same question and direct it to you, Soji, first, is, as the GCF, you're leading, blended finance. Many projects, from the GCF are blended. So what are you doing? What is the GCF doing in that sector? And how do you see, blended finance?
Yeah, okay. Good afternoon, good evening. Thank you for that. My name is Soji Omisori. I'm the Deputy Director, Acting Director for the GCF Private Sector Facility. So in terms of what we do, so basically I think before we kind of jump into it, it's good to step back to understand the reason for our being. We were created in order to channel funding from the global north to the global south for projects in climate impact. So for us, we typically, when we look at opportunities, we typically look for opportunities whereby we have what we call a dual focus. First of all, in terms of developmental impact or climate impact, and secondly, financial return. Financial return actually takes is not for us as important as the climate impact. However, as we know what's going on globally at the moment, there are a lot of challenges in terms of rising inflation. As a result, interest rates are going up, cost of capital is increasing, and supply of capital is being constrained. So, within that context, there's greater demand across the board, not just from the private sector, but also from the public sector. So, for us, we seek opportunities whereby we are able to add what we call additionality, which I'll come to later on. But it's important that we also have projects that are sustainable. And what I mean by sustainable is that they are able to be commercially viable. So for us, what we do, we provide concessional funding across the capital structure, debt, equity, grants, guarantees. We seek to take a lower return. So, for example, we can take a much lower return than the private sector because the private sector has a slightly different return expectation. We're willing to take a lower return in order to ensure that they come in, as in we mobilize private sector funding. And we look at different type of investors in terms of banks, pension funds, insurance companies, and equity. In relation to that, I think it's important to give context in terms of the private sector. Of course, I heard some of the comments being made in the first session. And from our research, we estimate that there's roughly about $95 to $100 trillion under management by the private sector, from insurance companies, pension funds, asset management companies, etc. However, less than 2 to 3% of that has been channeled into climate and ESG impact. And within that, we are part of that small percentage. So it's important that one has that in context. In terms of our kind of investments, we look at taking early stage risk. Even from a kind of a concept stage perspective. The idea is to invest in new opportunities, greenfield opportunities, new innovations, and try to develop and fund new business models, etc. We know that debt is not able to, debt is a different type of instrument. It's not really workable within that context. So we seek to fund those through equity and grants, and very much act as what we call anchor tenants. But I think it's important from our perspective to state that my last point on this question is that we look at what we call the paradigm shift, whereby we look at opportunities at scale. We are not seeking to do investments one by one. We want to basically fund opportunities where we're able to have huge scale in the markets which we operate in, which are mostly LCDs, or LDCs rather, most of Sub-Saharan Africa, and SIDS, Small Island Developing States. I think I'll stop there for now, and I'll give the others opportunities to speak. Thank you.
Thank you, Soji. And maybe same question for you, David. So as an asset manager, managing multiple blended funds, how do you work on that, and what's your view on blended finance?
Sure. Can everyone hear me? So great to see everyone. I'm David Kogut. I'm a partner at Pegasus. As David mentioned, we've launched 2 blended finance vehicles in the past 3 years in partnership with the Green Climate Fund. One is called the Subnational Climate Fund, which the R20 and Gold Standard are partners of ours in. It's a $750 million blended finance vehicle anchored by a $150 million junior tranche from the GCF. What does that mean? That means our $600 million, to Soji's point about crowding in dollars, our senior investors put up $600 million. They get all their money back plus 8% before our GCF sees their money. Obviously, we think we're going to do better than that from a return standpoint. That's as someone who looks at the pipeline daily, we certainly will. But you know, for us, what that means is GCF is saying we think these deals are worth the risk. Crowd in $600 million, and then when it comes time for Fund 2, after we prove we can generate 12, 15% returns, real solid infrastructure returns in these 42 developing world countries, then we won't need that junior tranche from the GCF. The concept will have been proven, and hopefully others follow us into the space. The second fund is a $500 million fund called the Global Fund for Coral Reef. It is an adaptation fund focused on the 10% of resilient reefs that are able to survive global warming and how we can protect those. So that's focused on ecotourism, waste management, sustainable aquaculture. There we're anchored by an $125 million junior tranche, $375 million senior tranche. Green Climate Fund provided the entire junior tranche. Our senior investors get their money back plus 8% there. GCF then gets caught up to a 4% return, and then the investors split the money pro rata. Again, GCF serving a critical role there in crowding in dollars, you know, since there is a perception by investors that these are riskier. Now, each of them, I think, has different sets of risk. You know, real assets in the developing world with long-term offtake, I would argue, from a yield standpoint, are more attractive than developed world infrastructure, but there's a perception in the market that it's riskier. So having that junior tranche is incredibly attractive to, again, crowd in those dollars. Coral Reef, there's never been a Coral Reef fund, so I get why people want to see that junior tranche, but I look at the sectors, you know, I think we'll generate great returns and not take too much risk. So I think blended finance is critical. Ultimately, you shouldn't need the blending, so prove it out with the blend and then do a great job and continue to raise money thereafter.
Thanks, David. Very insightful. So Vito, CDPQ is one of the largest asset owner in the world. So, you know, for you, how important is blended finance, and you know, how are you looking at that perspective?
Thanks, David. I should give a bit of context before I get into the importance of blended finance as a tool. CDPQ's second largest pension plan in the world, 400 in Canada, 400 billion in assets under management. I run a book of business that's a subset of the fixed income portfolio. It's a $4 billion portfolio, and I need to deploy at least $1 billion a year constantly. That's how those are the metrics that I need to follow. The majority, and actually almost all of the investments that I do are in emerging markets. Now, let's backtrack 7 years ago, which is when I joined the firm. Emerging markets for CDPQ was Mexico, Colombia, Brazil, India, and China. 5 markets. It had no offices worldwide, and the whole view was a concentrated strategy where we would start by investing in these markets because we didn't have experience in these places. And so today, as an example, we own $6 billion, close to $6 billion worth of assets in India, and the story is the same in the other markets that I mentioned. However, since then, we've opened up our investment universe to about 25 different countries. Nonetheless, less than 0.3% of those assets are in the LDCs and SIDS, mostly through index fund positions. There's been no private direct investments done in these markets, irrespective of climate finance or anything like that. So that gives you a little bit of context. Now, the question is how do we use blended finance? blended finance is not new. I mean, it's been around since I started in this business over 20 years ago. IFIs use it on a single project level, viability, gap funding, first losses, guarantees. These are common tools, and they've been used in emerging markets on the frontier and in middle income countries for a long time. The question then becomes, how does someone like me who needs to deploy $1 billion and my average ticket size is $200 to $400 million and I can't walk into a credit committee without a $100 million check, walk into the LDCs, the SIDS, lower middle income countries, and deploy capital at scale? That's what we're trying to unlock. And I heard a great line on the panel that I just came from, which was, the financial system is not fit for purpose. Meaning that we're trying to solve a problem using tools that have historically been around, but yet we don't exactly know how to put them together in order to mobilize some, I can't remember who said the trillions or multi-trillions of dollars. So I think it was Soji, you said the multi-trillions of dollars that exist in the portfolios that we, the real money or institutional investors, run. And when you look at this problem, it's a problem that has multiple elements, and that's how I always like looking at things, is we need to look at the problem statement. And the problem statement is simple. You have limited institutional capacity on the other side who's trying to implement NDCs and NAPs. You don't have enough ability to prepare the projects, nor the technical assistance is available there to help those countries get those deals to bankability. The investors themselves don't know how to organize their structures to mobilize for small $5 to $75 million deals, which is where the majority of these transactions are located. And then finally, you have to execute this fast because it's a competitive market. And you got to do it in a format that provides attractive risk-adjusted returns, as my colleague here on the right says. And so what's the solution? The solution that we've been looking at building is blended finance platforms that use all of these elements, and I call it the life cycle of a deal, from cradle to grave. You actually need to look at the entire line of business, from the creation of that project by creating project preparation facilities, by crowding in different types of philanthropic, climate experts, and public sector capital that's interested in providing that to make those deals work and be created. Then you need technical assistance to get those investors picking up those projects from those project preparation facilities to bring them across the line. And then you need to use things like the Green Climate Fund is providing, and others in the market, including governments and philanthropies as well, to build the capital stacks necessary to attract private sector capital like myself that's on a interesting risk-adjusted return and that can pass a credit committee, because that's the hardest part. And once you've done all that, you need to be able to execute. And the answer to that are blended finance facilities that have all of these elements inside and look at the problem holistically, not on the one-dimensional project level that we used to look at them. And so that's how we're looking at blended finance and why we think it's extremely powerful.
Thanks, Vito. I see you have at least one fan here. No, thank you, Vito, and I think it's, again, very insightful. So maybe now my next question. So we've heard of asset manager, asset owner, blended, but let's face it, we're all here to deliver impact. I know all those fun, without delivering impact would be somehow, business as usual. So I'm very pleased, to have you, Maggie, with us today. And, maybe you can tell us how Goldstar, help fund manager, asset owner to manage and measure their impact.
Thank you, David. And in most of the panels I go, I'm usually left at the end to talk about impact. And what I really want to stress is impact, as Vito also described, has to be embedded in the entire value chain of a project, program, development, and delivery. So I go back to Molly's earlier question, are you optimistic on private sector engagement and private finance really bumping up and accelerating progress towards our goals? Yes, yes, yes. Because 5 years ago, I couldn't imagine a panel like this that was actually working and speaking similar language, having aligned goals. And it's just 5 years ago. We were advocating for more private investment. We're talking at millions of dollars. Now we're talking billions to trillions. I think that's a very impressive progress. Still not enough, but we're getting there. And so I'm very hopeful. And I'm really grateful to be partnering with a number of financial experts. And a lot of people say, what is gold standard as an impact standard doing in the mix of financial experts and financiers and investors? And that's where we come in to ensure that these projects are designed, developed, implemented, and exited in the way that impact is integrated in every stage of that consideration. So I always joke about how brave Pegasus is to be partnering with one of the most rigorous standards out there in the world right now, gold standard. So we've been around for 20 years. We were born by WWF and like-minded NGOs to ensure environmental integrity and sustainable development in the carbon markets 20 years ago. We've been operating and really advocating for the high integrity carbon projects, and was the first to introduce SDGs as a requirement to those carbon assets, and now really working closely with investors and governments to look into ensuring integrity and maximizing impact in various financial mechanisms, including the blended finance. So I always joke about how Pegasus is so brave, because you can imagine a 20-year-old standard and verification body talking about baseline, additionality, sustainable development indicators to a London, New York-based private equity bankers. I really feel that we underestimate the importance of that working culture, understanding each other, where different people come from. GCF works in a very different way compared to how Gold Standard makes decisions, how Pegasus makes decisions, and I'm sure how CDPQ makes decisions. So how do we make sure that we work together on that and make sure that impact is not sort of an ex post thing that auditors need to do, but just start to embed that from a design stage all the way through, so that the fund managers speak the same language as the standard, and the investors start to understand the same impact as we understand as we review those projects. So I think it's been a really interesting and exciting partnership. I'm really honored to be part of that, and annoy a lot of our friends in the private equity to push that indicator concept. And it's not an easy concept to embed in your investment decisions. And sometimes you need to make those hard decisions. And it's really good to be working with partners who have aligned vision on that. So yeah, it's been very much a learning journey and an exciting journey. And I'm really excited to learn more about how we're gonna deliver this and scale it. So thank you.
Thanks, Maggie. Thank you. And so if you allow me, also referring to what, I will start to shuffle the order. So maybe I think, it's, David, so we heard Maggie, speak about the Subnational Climate Fund. You're the asset manager of it. So how was the journey? Now we're 1 year in, managing the SCF. What are the early successes you can already mention? And, if you already have, a feedback to give to the audience.
Yeah, so look, SCF is incredibly innovative, I think. Again, bringing together R20, IUCN, Gold Standard, anchored by the Green Climate Fund, and then us as fund managers originally, private equity people originally. Where I'm most optimistic, frankly, is the pipeline. One of the things I remember going to investor conferences is everyone keeps saying there's no deals. There's no deals, they don't have enough return, they're too risky. I look at our pipeline today, a year in, and I'm pretty blown away by both the return. We've got a project in the Dominican building essentially 400 megawatts of solar with the first storage component in the Dominican. The returns there from, limited currency risk, limited credit risk, are north of 18% on our sort of base case return with upside beyond that. I could go through the entire pipeline of about, today, $500-600 million, and am pretty blown away by the risk reward, the risk adjusted return. So I would say that has me incredibly excited, that it's both generating the return and then getting to the gold standard piece. It's also able to hit our impact goals of, the fund has the goal of, over its life, mitigating 82 million tons of CO2. So making sure versus baseline we're able to do that as well, having that return and impact is pretty powerful. From a frustration standpoint, I guess the one thing I would say is obviously on the fundraising side, I've had, I think, a few too many conversations with people who tell me it's emerging markets, it's too risky, which, risk is something we all live with. And I think, if there's an area you should take risk, it's with a blended finance junior tranche protecting you. I'm sure everyone's been reading the news today, but there are risky assets not in the emerging markets. I guess FTX was Bahamas based, but that was a $32 billion wipeout. And I saw one of your competitors, I don't know if they're competitors, but Ontario Teachers, they came out and said they lost $100 million on the FTX wipeout. And the good news was it wasn't material to them. So my view would be, if it's not material, take some risk doing some good for the world. But that's just my opinion. And I think now I'm very happy with people are starting to shift that dialogue and realize that the risk reward is incredibly attractive. So I would say my frustration is now turning to a positive. And obviously, again, it's essentially an 80% LTV loan given the 20% junior tranche that the Green Climate Fund has.
Thanks, David. And so maybe linked to that point, Vito, as an asset owner, having heard, David's point, how do you feel that CDPQ can lead the way, and is the fact that institutional investors like you can unlock those billions and trillions we need? What's your view on how to scale up from where we are today and where we want to go?
Absolutely. So, unlike the experience you've been having, we have, as an institutional investor with $400 billion worth of capital, our objective is to ensure that we build a diversified market portfolio. So for us, we own B- credits, we own AAA credits, and everything in between. We own equity, we own private equity. We're the second largest infrastructure investor in the world. We're one of the 10 largest real estate investors in the world. We have subsidiaries that do all of this. And so, question for us is, where can we go find opportunities that give us the scale that we need as our portfolios are growing? When I joined 7 years ago, the portfolio was $150 billion. 7 years later, it's $400 billion. And that's through accretive returns and deposits from the depositors. And so our issue is different. Now, what does it take to get into these markets? There's a couple of things. Remember when I said that 7 years ago we only had 0.34% or something like this, and we were only in 5 markets? The actual numbers are staggering. I'll give you another statistic. 7 years ago when I joined, there was less than about 5% in emerging markets, and mostly through indices, not very direct. Today, that number is 18%. Do the math, right? I told you it was 150, now it's 400. And that was on a concentrated 5-country strategy that just unlocked about 2 years ago. Those numbers are staggering. And what I say is, you talk about this cognitive dissonance between, or it's perception risk is what it is, and it's a personal experience that I've had being an emerging market investor. Investors have home bias. It's normal. We're used to where we are. Dominican Republic bonds for people from the Dominican Republic are considered AAA for them. That's their bonds. It's the same thing for investors in a place like Canada. We're used to investing in Canada. Less than 20 years ago, all we bought was stocks and bonds. Today, we're the second largest infrastructure investor in the world in real estate. It's a huge difference from the way we started. And so I think in order to scale, you have to get over that perception risk. You have to learn to walk before you run. You have to have blueprints that actually make sense. And at the beginning, and it goes to one of the things that you said, and I think, what Soji is talking about, paradigm shift, you have to be able to use concessionality in the most effective way possible, because there's not enough of it in the world. And so you need to be able to create massive leverage multiplier effects where borrowers and investors like us say, hey, you know what, this doesn't look as risky as it does. I've got a 20% first loss. Maybe it's something that on a risk adjusted return I should try, and I should do it in the best possible manner by implementing impact safeguards and being as strong as I can be in these markets. This is what's necessary, and I think this is where the market is going. I don't think it's a surprise that we're sitting at this table now. We have a very strong climate policy and strategy, and that's now being superimposed on the way we look at investing. My variable pay is linked to climate targets at work, meaning that I need to reduce the carbon footprint of CDPQ's portfolio every year, and if I don't do that, I don't get paid. That changes the way you look at the world, and it changes the way you look at impact. And so I think these things are happening. CDPQ is a leader, I will admit, in this space, but people look at what we do, and I think that as we move forward in this direction, that you're going to see more people follow, and that's the paradigm shift that you're talking about.
Thanks, Vito. And so, linked to this point, we've been speaking about concessionality. Everyone needs concessionality. So, as the leading provider of concessional capital, Soji, what's your view on concessionality, and what is for you acceptable as a blended finance tool?
Thank you for that. Before I kind of speak to additionality, I'd like to kind of add a little bit to what Margaret, what you said in terms of the general movement of the private sector, and without a doubt, I fully agree with you that there's been huge movement, huge interest in climate and overall impact. I think what would help, a number of things. Firstly, in terms of what I call deal flow, having good deal flow. It's not investors don't want to do kind of individual deals one by one. Depending on the way your cost structure is, and especially the private sector, the investment banks, efficiency is absolutely key. They have what I call a relatively expensive, cost base, i.e., the cost of their resources is high. So they want to ensure that they have deal flow and they're able to use those resources efficiently. That's number one. Number two, in terms of structures. The reality is that some of the jurisdictions that we typically focus on, there are challenges, and I think that ensuring that the structures whereby from what I call the capital structure as well as the legal structures of individual projects or collective projects are absolutely key. It creates efficiency. And I think, from a documentation perspective, we need to look at standardization, kind of legal documents, environmental, documents and methodologies. Those things are absolutely key because they provide greater transparency, and it cuts out repetition. And with reduced repetition, you have a great efficiency, which lowers your cost. And lastly, I think viability. I don't want to use the word bankability, because I think in the space that we're in, it can be confused. But the thing is that investors want to invest in opportunities that are sustainable. Sustainable means climate impact, sustainability, and without a doubt financial sustainability, because without financial sustainability everything falls down. So I thought it'd be good just to share some of that. So to come back to your point, David, I think the things that what is additionality? For us, we consider additionality anything kind of beyond just the basic financing. We do not want to compete with the private sector in the deals and opportunities that we consider. We want to bring in the private sector. So the ability to look beyond just the return is absolutely paramount. We provide long-term funding. Most commercial entities, do not provide that. And even though we do not provide, hedging, we do support financial institutions in the markets in which we operate in who are able to provide local currency funding, because that is key. We all know where we are today in terms of, kind of currency, forex volatility, how there's been a flight to, safety in terms of the dollar and the dollar strengthening against, kind of the basket of currencies, whether it's, euros, pound, yen, etc. So we've seen that, and from in terms of the markets which we operate in, and some of the difficulties in terms of convertibility in those, the volatility, of those currencies vis-a-vis the dollar is a lot more magnified. So the ability to provide long-term funding in some cases, from local currency perspective is absolutely key. The ability to also invest across the capital structure is paramount. We are not a rated entity, so we don't need to protect our, our AAA rating. As a result, we are able to invest across the capital structure, in terms of, sub debt. We don't do as much senior debt. We do a lot of sub debt. We also do junior equity, first loss kind of structures. So, those are some of the things that we do. We provide grants, which a lot of the kind of commercial players don't do. And lastly, we also provide, in terms of funding perspective, we also provide PPF, project preparation funding, in order to help, firstly, increase capacity of, of the project promoters. That's number one. And also, in many cases, provide grant for things like feasibility studies, etc. So those are key for us. We also fund what we call, green financial institutions. So beyond the financial metrics, the idea is, and I think, Margaret, you indicated that. The idea is, to make the climate impact kind of, part and parcel of the measurements and the kind of the performance that we anticipate. So greening the financial institutions of local and local institutions and domestic institutions is absolutely key for us. So in short, those are some of the things that we consider in relation to additionality. And just to give an example, I think it provides more context, more granularity by providing an example. Recently, we also funded an opportunity called the GGC, Green Guarantee Company. The idea is to help the private sector, as well as the financial institutions in the markets in which we're operating, access the capital markets. However, as per what Vito mentioned, there are kind of significant constraints in terms of their credit rating. Most of them are non-investment grade credit rating. So what GGC, the purpose of GGC is to provide these entities with guarantees that basically allows them to achieve credit ratings that breaches the sovereign rating. And as I said, the sovereign rating in many cases is non-investment grade. And what that does, it allows them to access a pool of capital at a more affordable price than they ordinarily would. In the interest of time, I think I'll stop there. I think you wanted to. Okay, sorry. Okay.
Thank you, Soji. So, Maggie. Okay, sorry for that. No, thanks. Thanks for the very detailed answer. So, also referring to the first panel, we've heard speak about projects, and again going back to the impact, which is why we are all here for. Maggie, so we speak about nature-based solution. We've heard nature-based solution project earlier today. Everyone here also even though we didn't really discuss about the underlying asset, but everyone is doing nature-based solution. And so I know for a fact that Gold Standard is today working on NBS standard. And so could you give us a few insights on what to expect for the future in that respect? Thank you.
Yes. So NBS, it's a big word. I still try to wrap my head around it. So we partner with IUCN, the International Union for Conservation and Nature. So IUCN has published its nature-based solution standard. So it's at a principle level, high level, and how do you actually translate that to be applied to a project or a set of projects level, so program level. So that's where Gold Standard and some of our fellow standards as part of ISEAL are joining forces to actually implement that certification scheme around it. I think nature-based solutions and the earlier panel discussed resilience and adaptation. And this COP, I'm finding it, I think this is my first COP where I'm actually hearing a serious commitments around adaptation finance and private sector engagement. Like actual private equities and banks actually committing to millions and some billions of dollars of adaptation finance. I think it's important as we level up that investment that we don't fall in the trap of impact washing, integrity washing, and greenwashing in general. And adaptation financing is you can easily fall into that pitfall. So we're working with partners to develop that adaptation standard. And one thing as a standard, I need to admit, there's so many standards. And if I'm a financial institution, if I'm a corporate, I would be asking myself, who do we go with? What's the global north? And I think that's the role of the standard, to make sure that we invest in harmonization. So what we do at Gold Standard, for example, the fund requirement that's being applied to SCF, the Subnational Climate Initiative, is to basically we embed our principles, our Gold Standard principles of safeguards, local stakeholder consultation, gender equality, and SDGs into our screening process, but also make sure that we harmonize with OECD blended finance principles, IFC principles, UNDP equity principles, so that if you are using and working with us, then at least there's a good amount of boxes that you can tick without going through lots of pages of requirements. So I think that's one thing that not only Gold Standard, but many standards can start to harmonize and create that alignment. So hopefully with adaptation and resilience, we're just launching our adaptation framework. We've piloted that with one of the projects under SCF, and also looking for a number of pilot programs that will test that. So hopefully I'll have a lot more to share in terms of experience, where we need to improve, where we need to further strengthen in terms of other existing metrics, and how we can harmonize on that.
No, thanks a lot, Maggie. So this is how we conclude our panel. So again, big thanks to all of you. It's great to be, with practitioners who really invest and do it. So thanks for all of you. And maybe Molly, do you want to give the last remarks?
You can stay, or you can. If you go, then we won't have anyone left. No, I'll be really brief because I do know that folks have receptions to go to. For me, I found this extremely fascinating and encouraging. I mean, the performance-based pay is something that I think we should all think about. When I thought of that, I thought, oh wow, that's a legitimate incentive right there. And I think one thing, I've been working on adaptation, climate change, resilience for a really long time, and been working more and more with investors, particularly new projects, to integrate resilience into carbon projects, for example. So that's one area that I think maybe bears a little bit more thought, and it's great to see that Gold Standard is also developing nature-based solution standards for that. I think that's it. I have all these notes because I was so excited to hear what you all are doing, but just really appreciate everyone's time, and for those who made it through the end, thank you very much. I've been meaning to note, like, if we were in the pavilion right now, it would look like a packed house. So just, you just have space, that's all. All right, thank you all for coming. Appreciate it.